Cramer. Welcome to Bad Money. Welcome to Cramerica. I'll be with my friends just trying to make you a little money. My job is not just to educate, but to entertain, to teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. As the market gets weighed down by a flood of new tariff announcements, Dow slipping 279 points, S&P declining 0.33%, Nasdaq dipping 0.22%. We have to remember that stocks are holding up incredibly well versus what you might have expected a few months ago. At these levels, the market remains pretty overbought. You know, I don't like that. But all of the new tariff threats barely dragged us down today. What we're seeing here is resilience, something that stems from tremendous demand for stocks for individual investors, which is something we share with an assembled crowd of CNBC Investing Club members in our annual meeting earlier today. The individual investor, amazingly, is so far undeterred by the harsh words and the tariff noose tightening that has now become commonplace. So with that in mind, why don't we check out what's on tap for next week? Remember, we're headed right into earnings season. On Monday, though, we'll have to sit through those new tariffs and penalties in another half dozen sovereign states. Always intrigued by how few countries seem to understand that it might be actually worth it to cut a deal now versus later. There'll be no doubt. Look, we're going to have new tariffs to study as the White House never sleeps. And we expect to hear something draconian about Russia. Whatever draconian counts as these days, it usually affects the oil market. You know, I think oil is going lower. Tuesday, it starts. And are you ready for it? Earnings season in full swing with the financials starting things off as always. Hey, they were terrific last time around, but the economy's got a little weaker since we, so we're going to have to hear if there's any pickup in loan losses or slowdown in spending. The star of the show is always J.P. Morgan, and it's Jamie Dimon. It's the CEO. Been there since 2006 now. But I care tremendously, actually, about charitable trust holding Wells Fargo. Now that their asset cap problems are behind them, who knows how high CEO Charlie Scharf can take an unfettered Wells. One thing's for certain, it doesn't matter what CEO Jane Fraser says at Citigroup, everyone's going to raise price targets and praise the bank anyway. Yet, you know what the most exciting story might be? I think it might be BlackRock. Yes, the stock that caught fire recently, even after many investors had lost faith in it. That never made sense to me. BlackRock's the largest asset repository in the world. And it has a new infrastructure component that I sure wish I could get a piece of, but it's only for 401ks. I bet CEO Larry Fink will tell a very positive story, more than justifying the stock's recent breakout. On Tuesday morning, we get this consumer price index report. Now, I know the president thinks it's time for the Fed to cut rates, but the Fed wants to wait to see. Look, they got to ensure that inflation won't make a comeback. It can't. The CPI number might be fodder for the Fed to stand pat, as we're only just beginning to see the impact of the tariffs. Wednesday, we hear from the two big investment banks, Goldman Sachs and Morgan Stanley. I think both will have terrific numbers and even better stories now that the mergers and acquisition business has exploded and the IPO market's warm, bordering on hot. What a change from even 2 months ago. And these two companies are going to reap outsized benefits. You know I like them both. My charitable trust owns Goldman Sachs, my alma mater from the 80s. Next, we know the semiconductors have become the hottest group in the market as the torch has been passed from software to hardware. Will that extend to ASML, the Dutch semiconductor capital equipment company, with an effective monopoly on its stage of the supply chain? We could be in for another round of semi-buying if the numbers from this one are good. Let me ask you something. Why is Bank of America stock still just selling at 13 times earnings? The franchise has been putting up consistently terrific earnings. Brian Moynihan's doing a great job. I think the stock's cheap because of the relentless selling from Berkshire Hathaway. One day, Berkshire will finish selling. And when that happens, you'll be paying a much higher price to earnings multiple for this fine bag. My advice, don't wait for them to finish. It'll be a good quarter. Johnson & Johnson kicks off pharma earnings season on Wednesday, and I think once again the company will not be rewarded for its consistency or its originality because there's still the sword of the talc lawsuits hanging over it. I don't mind J&J fighting the plaintiff's bar, but it sure puts a damper on the stock. Thursday morning, we find out about retail sales. Now, I am very concerned about a slowdown in retail as the uncertainty of Washington seeps into Main Street. I suspect that weak numbers have already started. Then one of my absolute favorite companies, medical device maker Abbott Labs, reports. And you know, I always like to tell you which companies tend to be misinterpreted in a negative way during the earnings season. Abbott's a textbook example. It bothers me, but there are always sellers who claim to be disappointed. So if you don't own any Abbott, may I suggest that you wait to see the numbers, wait for the stock's opening, wait for the sellers to appear. Patience is a virtue with ABT. if you want to know a stock that's too cheap relative to its growth rate, but nobody talks about it anymore, why don't you check out the stock of PepsiCo? It trades at a staggering low 17 times earnings. I mean, what gives? Well, how about GLP-1 drugs? How about RFK Jr. at Health and Human Services, who despises junk food, even as he seems to embrace junk science? How about the desire to stay healthy? All these have weighed on PepsiCo stock. Of course, don't forget they own Frito-Lay. Maybe it's finally overdone. I don't know. It's a tough industry all of a sudden. After the close, we're treated to the most delightful of conference calls, Netflix. First thing. I have a dearth of things to watch right now. It's really starting to bug me. So I'm going to be listening to the conference call in part because they talk about all the great overseas programming. I get some terrific ideas of what to watch when I get home that night. The bar is very high for Netflix, though, which will have to tell us how their ad tier's going, how Squid Game did, and how NFL Christmas streaming football advertising's looking. If Netflix doesn't deliver an outstanding number, though, I got to tell you, there'll be an awful lot of downside. We have so many price target boosts, even two today. I'd be a little nervous, even as I expect a good quarter. Then on Friday, there's American Express, which is another stock that tends to sell off when it reports, no matter how good the numbers are. That's why I always tell you to wait until the selling subsides if you want in. This time so different. I don't think what the sellers, I don't know what they're thinking about, the sellers of American Express. They've been wrong for 150 points. Look at that stock. Listen to the call. This company is a unique, beloved product that young people cherish. What's not to like? Steve Squeri, CEO, one of the great ones. Well, he'll have a terrific call, and he will, you know what? He will tell us about why American Express card has now become not a product of a different era, our parents' era, but a product of everyone. Everyone wants to think it's prized. That stock's going higher. Now, the industrials have been on fire. The part of this broadened out bull market, and one of my absolute favorites is 3M. Which is beginning to remind me of the old 3M, where the question was simply how big the beat will be. CEO Bill Brown is crushing it. And this one's been greeted with buying, both before and after the conference call. Finally, don't say I didn't tell you so. We've been championing Charles Schwab from the days when the doubters cast aspersions on the balance sheet. That was 25 points ago. They've been silent of late. But I think the short sellers like to come out and color the opening of trading when Schwab opens. I say be very careful before you do some buying. The bottom line. Once we process the new tariffs, we've got a ton of earnings reports coming next week. So you better keep your eyes open. And don't forget that Abbott Labs, American Express, and Charles Schwab are likely to sell off regardless, even if their quarters are spectacular. Because that's just how those stocks trade. Let's start the question with George in California. George.
Yeah, hi, Jim. Am I too late to jump in PLTR, Palantir? It's run up
Palantir, when it was at 50, I said it was going to 100. When it got to 100, I said it's going to 200. So in that sense, the momentum is still with you, and it is not too late. Now, does it deserve that? These guys talk a big game. It's a meme stock, okay? Like Robinhood, it's a meme stock. The memesters won't let the stock come in. It's not a good reason to buy, but I'm telling you where it's going. David in New York. David.
Hey, Jim. Thanks for taking my call. Appreciate it. I was just calling about Pfizer, and I've held on to it for a while. I think a few years ago or a year ago or so, you may have recommended it. And it hasn't really gone anywhere. It's still got a really nice dividend yield, about 7%. And, just technically, it looks like it's a good spot to buy it. But, it's not really going anywhere, so I was just curious what you thought.
Okay, well, I've not been recommending. My stock in the pharma business is Lilly, and the med equipment is Abbott. I do think that Pfizer is an inexpensive stock. They have to have some sort of catalyst. They have to prove that they have some new cancer formulations with Seagen. If they don't, you're just going to be marking time, picking up that 6 3/4 dividend. That is what will happen. How about we go to Carol in California? Carol.
Booyah, Jim.
Booyah.
So, Jim, I'm calling from Los Angeles, as you know, and I've got a question about a stock my husband bought during the pandemic that turned out to be a big win for us. So,
that stock is? Yes. Just tell me what stock
G.
G is fabulous. G is fabulous. And I want you to hold it. Now, I mean, look, the temptation would be to cut some off because they just had a giant move. If you want to trim a little, that's fine. But I think that Larry Culp is going to tell a great story. It doesn't mean it can't come down. The stock is up in a straight line for up 53%. So any stock can be vulnerable, but I think it is one of the best in the book. Hey, twofer, I really like Boeing, too. I think Boeing seems like a very solid buy right here. All right, listen, once we got through the latest tariff news, earnings season, season starts in earnest, so make sure to keep your eyes on the prize. On Mad Money tonight, Capital One completed its acquisition discovered in May, and I'm running through the reasons why its shares could be headed higher, maybe much higher in the months ahead. Then, is now the time to try Contour brands on for size? I'm breaking down why I think the parent company of Wrangler and Cramer family fave Helly Hansen is a winner right here at these levels. And we held our Investing Club annual meeting earlier today, and we had so many fantastic questions from our club members that we decided to answer some more of them tonight. You don't want to miss it. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.